All right, so let's begin. What is imbalance? Now, this refers to a situation where there is a significant difference in the volume or value of buy and sell orders in a particular currency pair. This imbalance can occur for various reasons. Now, let me explain. The forex market, or the market generally, usually have to have a balanced or equilibrium point, in the sense that when we have buyers in the market, we also expect it to have a corresponding seller's price point in the market. So for every corresponding buy, there should be a corresponding sell to have an equilibrium market. The orders for buyers need to be filled and the orders for sellers need to be filled for us to have a perfect market structure. But that's not always the case, right? In some situations we might have differences, or one-sided market where we have more buyers and there is not enough sellers to fill up those orders, or to fill up the opposing side orders, and then it results to imbalance in the market. So that is why we have this definition as imbalance, referring to a situation where there is a significant difference in the volume or value of buy and sell orders for a particular currency pair. This imbalance can occur for various reasons. Yeah, obviously there are reasons why we could have a one-sided market, which creates an imbalance, right? One of the reasons is market sentiment. We could have a bullish sentiment in the market, for example, where the market is just buying, so we have more of the buyers in the market without a corresponding selling power or pressure, to fill up those imbalances, which will in turn create imbalance as itself, right? And another reason is economic events such as news. Sometimes if you've experienced news trading such as NFP, CPI, you would see that it would just be a one-sided push, and automatically it shows that what we have one-sided buyers or one-sided sellers in the market, and there's no corresponding or opposing orders to fill up to call the equilibrium, right? Now, in most cases when that happens, regardless of the time frame or the time it happened, the market will always tend to return to those areas to fill up those imbalances or correct the imbalance, right? That's why we have here, it says price tend to return to those areas to fill the insufficiencies or balance created within those areas to restore equilibrium. So once we have a market go up like this, we want to see a market corresponding down. That is where we have a perfect market, right? A perfect market, but it is not always like that in the market. So we're going to look at some examples of how a balanced market should look like, and an example of an imbalanced market, what they actually look like, right? Okay, so let's check this out. All right, so right here what you can see is a balanced price action and an imbalanced price action here. Now let me explain. There's something we call the 3-candle rule that actually helps you understand the situation of imbalanced market and a balanced market, right? So let us take, for example, this 1, 2, 3 candles. Now you see that this is more or less like a candle with a wick. So if you understand price action, if you understand how candlestick actually works, the psychology of candlestick and the dynamics, you understand that in a bullish market like this, a bullish candle, the open is always lower than the close of the candle. So the candle opens at this low level and closes above, and it just tells us that this candle actually opened at this price point here, and actually dropped down to this point, but it couldn't hold. Then it started going back up. That is how the wick is being created, right? That's candlestick for you. Now looking at this price action, you see that this candle opened at this point and closed at this point, and this is the wick that it created, right? So price actually got to this point, price actually got to this point, but this is the body of the candle. Now the next candle after this candle closed, the next candle opened right here, came down. That is creating what? The sell opportunity. So we have the buy market here, we have the corresponding sell to give you what? A proper price action, right? And now the next candle, you can see the wick right here, the same thing. And then look at the third candle, look at its wick. So we have this sell wick right here, that price moved down to this point, and then look at this first candle, price moved from this point to this point. So we can see that there is what? Equilibrium in the market, because at this point we have a corresponding buy and sell market, right? If I put a line right here, you see that price got to this point and also came out the other side and tapped it in. So we have a balanced price action. As you can see, the same thing if you're using this 3 candles, for example. Again, this 1, 2, 3, we can have this wick right here, and you can see the wick of the 3rd candle coming to mitigate this other candle, showing us what we have: a balanced price action, a fair and equilibrium market, right? So we have this here week, here this other week. So price always does this kind of movement, but there are situations where we can have price not mitigating those wicks or bodies of candles, right? Which is what we call imbalance in the market. So look at the imbalance price action right here. The same thing, it's a bullish market, and we see price using the 3 candle rule now, right? This is the 1st candle, the 2nd and the 3rd candle, and this is the wick created by the 1st candle. So we have this price points at this level, and market now made an impulsive push to the upside, right? And for the downside, we ought to expect price to at least drop down for the sellers to what correspond or meet at an equilibrium price right here, which is supposed to be this one. But as you can see, it just dropped a little and then pushed up and continue going. So this price point to this price point is what we refer to as imbalance or improper price action. Okay, I hope you understand that improper price action. Now, if we were going to look at this even deeper, this is how I'm going to draw it from this zone right here, or this point to this point. This is going to be right here. Okay, let me just fill this up with brown here. Okay, so this is what we refer to as an improper price action. So going forward, you get to understand that when price leaves an area like this, an improper price action or imbalanced market, it will always tend to what come back. It may not come back immediately, it may not come back in the next 5 minutes or in the next 1 hour, but it might take its time, but eventually price will come back to fill up this imbalance to correct the market. Yeah, so that in that way we will now have what a proper or an equilibrium price point in the market. So this market creates imbalance at different levels, at different zones, at different areas, and we can capitalize on that using it as an entry, using it as an exit. But if we add it to our strategy generally, it will now make sense how we're going to use imbalance with other companies that we're also discussing on this course to understand how the whole strategy works. But in this case, I just want us to understand how imbalance actually occurs in the market, right? So this is an example of what a balanced price action, and this is an example of an imbalanced price action. All right, okay, so let's get into the chart now and just look at some examples, some real life examples. Okay, so regardless of right now in this course, I'm not teaching you how to trade imbalance, I'm just teaching you how to identify imbalance, right? Generally, we're going to put everything together to understand how we can use it as part of our strategy. Okay, so remember that imbalance in the market is always been corrected, right? So regardless of whether price is going to correct and move out in the direction of the market or moved against, that is not the situation here. Right now, we just want to identify those imbalances and see how price comes back to correct them. Okay, so in this scenario right here, let me take this out first. You can see that we have this bullish candle. We created a wick that stopped right here if we're using the 3 candle rule, and then you can see right here price actually came down to almost, this was the 3rd candle, right? But we're not going to use this because right here price actually tried to drop down to mitigate or close this imbalance. However, it still didn't close the imbalance completely, so we still have improper price action from this point to this point. And we could draw it out like this using our rectangle so that we could see how price actually came in to finally close the imbalance. You can see right here price came and closed in the imbalance, right? Okay, so this is another example right here. Okay, so before all of this happened, let me take this out first. So we have what the improper price action right here from this point where this market actually got to. This is the wick, right? This is the body. Right here is the body, and price this was the last point price came down to. So from this point, or from this area to this area, is where we have our imbalance in the market. From this point to this point is where we have our imbalance in the market. And now you see how price came in after creating this equal level. Price just came in, dropped in, fill up the imbalance, and even moved down a little bit more, and then price moved away from there. This is how it usually occurs when price is feeling imbalance, but it happens in different dynamics, right? So let me show you a few more examples. So let's just go forward. All right, so before even that, let me show you this live example, because as at the time I'm recording this, we have the market just closed, so it's on a Saturday, and you can see that this is another imbalance here in the market. From this impulsive move, we can see that price got to this point right here. Okay, so you can see this week, excuse me, and then to this point. Now price tapped a little bit into it, but it has not completely filled this imbalance, right? So we definitely might see price come back eventually to fill this imbalance. So market might just open and then it's going to continue dropping without touching it or filling this imbalance, but later it might come back maybe when the trend has changed to actually fill up this imbalance to complete the proper price action. Okay, so just a few more examples. Okay, we have something here. Sorry, let me take this out. Okay, so you can see another one right here. So if I'm going to open this a little bigger, so you can see we have, this is the end of the week right here, and this market, this particular candle pushed up like this, and then we started seeing price dropping down to fill up the whole imbalance space, but it couldn't, right? So from this point to this point is where we have the improper price action. You can see price came down, filled it a little bit. It still didn't complete it at this point, but at least it dropped into the imbalance level, filled up a little bit. You can see it came down here and did the same thing. Eventually price filled it up here with this week. See, this first week came, filled up the whole imbalance before still dropping to the downside. That is how price will always fill up imbalances that it has created, or improper price action market has actually created, right? Okay, so this is another one right here. Now you can always spot them in different time frames, right? This is just 15-minute time frame. It can appear, imbalance can be created on a daily time frame, on the 4-hour time frame, on the 1 hour, 5 minutes. It doesn't really matter, right? It can actually be created at any point. You just need to understand the psychology behind it, why it's created and how it's created, and then you can actually understand how you could use it to trade, right? So you can see right here, this is another one here. If we're using the 3 candle rule, this 1, 2, 3, you can see how price pushed up, and we have this improper price action here, right? So we can actually even use from this point. Let me take this out. So this is actually what some people call fair value gaps, right? Where it's just terminologies that are being used by mostly ICT traders, smart money concept traders, and all of that, yeah. But it is actually the same thing. You just understand the psychology behind it. That is just what is important right now. So you can see here we have this fair value gap, as they would say, or we have the improper price action from this point to this point, and you can see how price came in and filled the imbalance. Now we have a proper price action. This week to this week, it's completely filled, so we don't have any imbalance here, and price just continues moving and moving. You can see right here from this point to this point, see how price came, fill the imbalance with a gap, opening gap in the market, and it just filled it up, right? So even here, like, you can spot it everywhere, guys, literally everywhere. You can see from here to here, improper price action, and then what happened, price came back up and filled it and started dropping again. So that is actually how the market moves and creates this imbalance. And I told you guys that it can be as a result of just the market sentiment, it could be as a result of the economic events such as news and all of that, or just market moving in a particular direction with fewer. When we have less liquid market, it could also be a result, it could also be a cause of where we have imbalances, right? Where we have market with low liquidity, so it's just a one-sided market, and then it could create insufficient price action while it's trending up or down. that is just basically the concept of imbalance. I hope you understand it. If you have any question, you can always reach out to me, and you can always watch the video again to see a proper breakdown so you can understand it even better, right? So this is just part of the strategy component. I will look at other stuffs, and then we'll combine everything together and make it a whole full-fledged body. All right, thank you. Bye.